Hey, Ben Kesnoka here, co-founder and general partner at Village Global, a network-native venture firm. What you're about to hear is a clip from a longer conversation. If you'd like to listen to the full-length version, find the link in the description. And of course, subscribe so you don't miss the next one. Enjoy.
Let's talk about your journey again. So you're out there, you're doing your crash course, you're building in public, you think about the Lean AI leaderboard, and then you say, today it's either entrepreneurship, VC, or a frontier lab. So walk us through the three options and what you chose to do.
Yeah, I think historically, as a repeat exited, more successful founder, I think many people felt compelled or maybe even trapped to the two paths of either being another founder or being an investor, right? And they feel like those two are the only two options available to them. And whether that's because of opportunity cost or lifestyle choices or preference or even pride in some cases, I think the common path are these two. And I think it's often very hard for founders to say, hey, I want to work for someone again once you've been caught by the entrepreneurial bug. And I can certainly relate to that. However, as I was exploring, I realized that there's a third path, which I wrote about in my post and content, which is a frontier lab, which is actually quite a little bit different, and I'll explain why. I'll explain the three options, and I'll explain why the third. So on the venture path, I spent a lot of time on the other side of the table. I mean, I have a lot of experience as a founder, pitching investors, getting rejected 144 times. So very much an experience on the founder side.
Their loss.
Yeah, and I can't say that it's been, and I think if you talk to most founders, it's one of the things they like least about starting a company, right? It's very much a song and dance, but what I didn't appreciate, or maybe I appreciate more on the other side now, as I spent time on the other side of the table as a venture partner or sitting in certain meetings, meeting hundreds of investors, and then having entrepreneurs pitch me, is that it's also very much a sales job on the other side. Some of the stats really surprised me, but once you kind of see it, it kind of makes sense, which is most investors, certainly the top ones, the partners might make 2 or 3 investments a year. Right, so that's they have to be super selective, and they are about picking. And when you're super selective, you kind of have to go for deals that you feel like can return the fund, which is returning nowadays maybe 10 billion or more, right? And oftentimes that means converging on certain types of founders like ex-OpenAI, Stanford researchers who are doing world models for XYZ, right? Because that is the consensus of these big $10 billion returns. And what happens is, but these founders, because they fit that profile, they have many options. They have many term sheets already. So your job ends up becoming selling founders who don't really need your money to take your money, right? Because they already have 10 term sheets. It's like, how do you convince them to take your money versus someone else's? And then the irony of that is the founders who actually need your money, who you can actually help, you don't want to help because they have no term sheets, right? And if you're going to do 2 deals a year, are you really going to take that bet on this founder who's maybe unproven, unknown, and has no term sheets and no real consensus? Right now, there are definitely firms who take a really contrarian approach, but for the most part, I think it's very much, well, there's this founder that fits the mold. They're going to be a $10 billion company. Let's convince them to take our money. And for me, it just felt like very much a sales job, which is fine, but I wasn't sure something that I wanted to do full-time right now. Maybe sometime in the future, but for now, I felt like I still had builder energy and drive to do something, and I wanted to help more founders. And doing 2 deals a year is very hard because you have to say no to 998 founders who pitch you. On the startup side, I also thought about it a lot. I was playing with a lot of different ideas and trying to test different things. But I think it came down to 2 things, which is one is there wasn't like a mission or maybe, just like a mission that I wanted to spend the next 5-10 years of my life solving. Like great companies take a long time to build, even Super.com, that was pretty much a 10-year journey. And so I knew second time around that it was going to take a long, long time. And I want to make sure that whatever I dedicate myself to, it's something that I really, really believe strongly in the mission, the cause. And that there wasn't that strong mission or cause just yet. And then 2 is I don't want to start up for the sake of doing a startup. You can do another B2B AI SaaS wrapper startup, and that's fine. And even these days, you can get it to 5-10 million ARR, and that's probably decent. But for me, my company's still going. I'm on the board. I'm fully vested. Companies continue to grow and scale, looking to go public in the next couple of years. So for me, it's like you can make an extra 10 million ARR here, or I can just tell my team to do it, and they can do it and grow from 200 to 300 and et cetera. And that's probably more impact and equity value. It's never been easier to go from 0 to 5, 10, even 20 plus million ARR, but it's never been more unclear who's going to go from 10, 20, 50 million to 100 and beyond. Right? You look at Jasper AI, for example, one of the darlings of the early ChatGPT era, 0 to 100 and now back down, and some are stabilized, but it's really hard to know who has staying power. And even some of these companies and the headlines you hear, like, are they margin positive? Or are they margin negative? How much money they're losing through inference, through model costs? So it's really hard to know who's going to be around and who's going to get replaced and who's going to get eaten by the models. So it's very uncertain. Now, this actually relates somewhat to this new type of funding called C-strapping, which I guess is a term that maybe I didn't coin, but popularized, which is this new form of starting a company, which is you take a little bit of seed capital and then you scale it, and you use that to scale it to get an escape velocity. So a combination between bootstrapping and raising a seed fund. But it's unlike bootstrapping, you're not paying out of your own pocket in the early couple of years, and you can play with someone else's money and get to growth. But unlike traditional venture, you don't have to keep raising series A, B, C, D, E, F, G, get diluted to like 2%, and lose control and have to deal with all these like board dynamics, et cetera. So it's kind of a little bit of best of both worlds. Before AI, it wasn't really possible because it was really expensive to build product, to bring it to market, to hire all these people. So you needed lots of, and you couldn't grow revenue so quickly, and certainly not profitably. So you needed to keep taking capital. But I think if we look back, a little bit of irony is, do we really need to invest $500 million to make a B2B SaaS company? Like, right? And now, especially with AI, you can certainly build all these things and get to scale. And because there's so much demand for and willingness to pay for AI products, you can get to market much quickly, much cheaper, and scale, make revenue, and be profitable. So if you have that, then the question is, what is the role of traditional venture capital? Right? So are there new forms of funding that can enable these types of seed-strapped companies? I'm sure they may not be $10 billion companies, but I think for a founder, if you're like 5 people making $10 million a year every year, that's pretty good, and probably you're probably doing better than most venture-backed founders, right? Who are illiquid, who are stuck, and whether they can or can't raise, but it's just tough, and you have a total flexibility and control. So then, are there new capital structures that can help scale these types of companies, whether it's like revenue-based financing or things like that? So these are some of the things I've been piloting with, and I know we chatted about this with Village as well. Can you back founders in the earliest of stages in some sort of founder-friendly structure that has early DPI and returns? It's not uncapped, but you're getting returns. You can recycle that and then help many more founders than just the two founders a year, because you have to return the whole fund. Versus here, you can help a lot more founders and help them get to seed-strapped escape velocity while still having good returns for the fund and early DPI.
Right. And there might be optionality, because some of those businesses might actually end up being huge decacorns or something like that, and decide to raise following capital. So we love that structure. Okay, but you rejected those two options of VC and founding.
Yeah. So after spending about half a year thinking through, learning, building, experimenting, I sort of came to the thought that if I'm not going to be an investor or start a company right now, and I'm going to do AI on the outside, may as well do it at the inside, at a frontier, on a good mission, make good impact with great people, great talent density, and really take my experiences as an entrepreneur and builder and apply it to a good cause and push it forward. And I think historically, this opportunity probably didn't emerge for many founders because there was nothing of such consequence or scale or excitement. I mean, maybe Google in the early 2000s, maybe, but I mean, really, this is maybe one of the biggest inventions of our lifetime, and many people say maybe the humanity's last invention, right, in terms of AGI. So, it certainly is very powerful, and I kind of saw the capabilities of these AIs developing exponentially, and I decided, you know what, if I'm going to do it on the outside, may as well do it with a good team on a good mission. So got in touch with some of the folks there because we were super early customers. I had a friend from Waterloo who was like an early researcher there. I've known Ben a little bit through the startup community. And we're just chatting a little bit, and they were like, hey, we have this 0 to 1 prototyping role. It's maybe good for founders. And I was like, sure, happy to roll up my sleeves and do whatever. Like, I didn't need to do XYZ or manage a big team. In fact, I probably prefer not to, because having gone through that, just having managed hundreds of people, you really kind of appreciate the fun and simplicity of just building. So we're chatting, and I think we were chatting through that process. And I think it was a little bit like I did pretty well. And then also they kind of realized I'd done a lot. So like, hey, maybe you can just help Ben directly and help across the org and bring some of that founder energy and experience and just help execute across the org. So that's kind of the opportunity. But Anthropic is very much very disciplined and pretty fair in that process. So I think everyone more or less goes through an existing process. And then through that process, eventually kind of maybe people figure out certain roles. But yeah, overall it was pretty fair and disciplined process, and I'm pretty fortunate to be able to make an impact on the inside at the Frontier.
Well, and it's amazing because the talent density there is incredible.
Mm-hmm.
Sometimes the flip side of talent density is a lot of egos and a lot of independent thinking, which isn't always good for alignment. And I don't mean AI alignment. Mm-hmm. I mean, human alignment. Right. So can you tell us a little bit how do decisions get made? How do priorities get set? Yeah.
So coming in, I think one of the first things I realized is the mission is very much real. You definitely feel the alignment towards the mission, but really care about it and take it very seriously. And on the outside, I think there's a little bit of skepticism around, like, are they just saying that? Is it just posturing? Is it regulatory capture? But certainly on the inside, it's very much real. People take it very seriously. It's very open, transparent. Dario gives these incredible, all hands discussions where there's no corporate speak. He'll answer every single question. There's no dodging or roundabout, just straight on, heads on, speaking very candidly. And I think that creates a lot of alignment and trust in leadership and the vision. And you see the decisions being made that don't always, oftentimes deprioritizes revenue or certain metrics that a normal company would care about, like engagement, clickbaiting, and things like that, really making tougher decisions to do what's right for customers, consumers, or even just like global good or beneficial deployments. So I think overall it's you definitely feel that. And because there's a very high culture bar in terms of the values cultures interview, I think you're selecting for people who really care about that, who are in it, who are here in it, doing it for the right reason. And I think people take that very seriously.
Thanks so much for listening to the Village Global podcast. You can check us out online at villageglobal.vc. We'd love to hear from you, your feedback, your ideas, your inspirations. You can email us at hello@villageglobal.vc.